Watch Budget 2018 with Bloomberg Quint.
Good afternoon and welcome. You're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines at 12. First up, it's a weak day of trade for the Indian markets as the Nifty gives up the 11,100 mark. All sectors apart from the PSU banks decline. Broader markets are in line. KPIT Technologies recovers from early morning jitters and jumps in trade after announcing its business rejig and merger with Birla Soft. Amber Enterprises lists at 1,180 rupees per share, a premium of more than 300 rupees on its issue price. And higher inventory is expected to help Indian Oil Corporation offset some of the impact of higher crude prices in the third quarter. That's the only Nifty company that will report its earnings today. And now it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests on the show, Dharmesh, Kant, Vinit, Bolinjkar, and we have investment advisor Vivek Mavani who join us on the show. Thank you all for joining me on the show. Today on Hot Money, we will discuss stocks like Hindustan Zinc, Tech Mahindra, Tata Steel versus JSW Steel. We'll ask our guest which is a better pick, and the top mid-cap picks that they believe could be bought for an investment perspective. Let's start with the first one, and that is Hindustan Zinc. Zinc prices are trading at 10-year highs now. It is doing well on the LME. It's doing high on the Shanghai exchange. But what's the view for stocks like Hindustan Zinc? We'll ask our guest. Vinit, any view on Hindustan Zinc?
Yeah, so this commodity in consideration is hitting plateau in terms of production. Resources are dwindling, and with the global economy picking up, I think the prices of both lead and zinc will tend to move up.
Okay.
And along with this is silver. So silver is an extinct metal almost, because silver gets consumed. It's a consumable. It doesn't get recycled much. So these three commodities will tend to move up over the next decade.
Okay.
And Hindustan Zinc, by being virtue of its having great ore content and having good reserves in place, is a perfect play on the metal story over the next decade.
Okay. So you're rather bullish on all three metals that it produces.
Yeah.
Okay. What about you, Vivek? Any view on Hindustan Zinc?
Well, Hindustan Zinc has been, if you recollect, just a few weeks back, I mean, this has been one of my top picks in metals space, and on this very program, I had recommended Hindustan Zinc. I'm extremely positive on that. Extension to what Vinit mentioned. I mean, Hindustan Zinc has got the highest and the best quality mines anywhere in the world. That's number one. Cost of production out of those mines is among the lowest in the world, and the cost is going to fall further as the operating efficiencies further play out over the next couple of years. Volume growth based on expansion in mining capacity would be about another 20% over the next 2 years. So we are talking of by 2019-20, we should have about 20-22% higher volume, number one. Zinc and lead prices have been on at elevated levels and likely to stay at elevated levels. So even now, Hindustan Zinc reports EBITDA margins with the vicinity of about 50-55%, which could be closer to maybe 60% going forward. A debt-free company that generates some crazy amount of free cash flows. I mean, even now, as we talk, maybe there is about 25-26,000 crores of surplus cash and bank balance on the balance sheet of Hindustan Zinc. So all of that obviously results in generous dividend payouts. Dividend payouts on a sustainable basis. Let's also recollect last year 27 rupees dividend included a special dividend, but on sustainable basis, the dividend yield would be in the vicinity of about 5%, is something of 5% of the stock price dividend yield that can sustain among the large cap stocks. And in it's very rare to have this kind of a dividend yield also play out. So I'm positive on all of the factors: volume growth, price growth, very strong balance sheet, and the works. one key trigger, whenever it happens, I mean, Government of India holds 26% stake, which eventually Government of India has to divest in favor of Vedanta Group. So there seems to be some news that Vedanta keeps the stock price suppressed so that they can buy it cheap, but that doesn't really work out. Whenever that trigger plays out, that there could be a spurt in the stock price.
Okay, so two positive views coming in. Dharmesh, would you agree with the views on Hindustan Zinc, a bullish call, or would you have a different view?
No, I would also have a bullish call on Hindustan Zinc. The company is a robust company, high cash generator, and zinc prices have almost doubled from the lows of 2015. I mean globally, and it's being used in multiple industrial uses. As far as silver is concerned, silver prices have not moved up drastically, so that's one I mean trigger which can give it a re-rating, because they have a huge reserves of silver and they are not mining it purposely, because when the demand is there, it's conducive, they will encash that. More or less all the operating efficiency is basically underground mining, which is expensive, but since they have got the leases very cheap, that's why you are having this high margins of EBITDA of 50 plus and PAT margin of 40 plus. So they were lucky to have the leases in time when it was allocated to them very cheap. Sufficient reserve is there. My own sense is that compounding of 12-13% on the volume side would be there. And blended realization will go up by 2-3%, keeping in perspective the cost escalation. So overall 15-16% kind of a steady state 2 years kind of a growth you can assume. On that basis, you still have a 15-20% kind of an annualized upside on the stock price.
Okay.
So one should be a buyer into it.
Okay, so it's a consensus bullish call that's coming in on Hindustan Zinc from all our experts. So that's the first stock that we spoke about. Let's talk about the second one, and that is Tech Mahindra. Numbers came out after market hours yesterday. A top line growth of 2%. Numbers came in line with what the street was anticipating. So the counter absolutely flat. But what's the trend for IT stocks going ahead? We'll ask our guest. Dharmesh, I'll start with you. Tech Mahindra, I was rather surprised, when TCS said that in the first, in this year itself, they've won deals worth almost $6 billion. So is it tied for IT again moving, and what's your view on Tech Mahindra?
I would disagree with that. That is whatever deal they have got TCS, and it's a general trend for the IT industry, because we are yet to hear such kind of deals from other companies being announced. So Tech Mahindra numbers were in line. There was nothing exceptionally good about it. At the same time, there was nothing exceptionally bad about it. There are multiple triggers in Tech Mahindra as far as currency is concerned. One is they have a natural hedge.
Okay.
Because 50% of the exposure is to US and 30% is to European region. So the currency move in tandem. They don't go in the same direction. If dollar is strengthening, you have a weakness in GBP in euro. So that hedging cost they are paired with. They don't have to bear that burden on the profitability or balance sheet. But at the same time, they are trying very hard to get their business skewed as far as multiple customers are concerned. Concentration risk is getting reduced day by day. Digitization, everybody is talking about that, be it TCS, Infosys, Mindtree or Tech Mahindra. So that is the play which is playing out in the market. At this price, 15-16 times on a TTM basis with a growth guidance of 10-12%, I think it's fairly priced. So as of now, one should stay invested. No, I don't see there's a sense to take new, fresh investment bets on Tech Mahindra. So if you are holding, stay long. Maybe you book part profit and see how this entire IT industry is pan out going forward. Headwinds are still there. I don't think they are out of it.
Okay, Vivek, do you agree headwinds are there for Tech Mahindra?
Well, of course, headwinds are there for the whole sector as a whole. So, but couple of points. IT spending and Indian technology companies have a strong correlation to the health of the US economy. So when US economy has been strong, generally the tech spending has been also at elevated levels, and Indian companies have as a result done well. That's number one. Tech Mahindra stands out among the large cap IT space over the last 4-5 quarters on 2-3 counts. So where your Infosys and Wipros of the world have faltered on delivering the growth and disappointed on the growth numbers, Tech Mahindra has surprised or delivered at least on expectations, both on the top line, positively surprised on the margin. So if we look at over the 4 quarters, I mean little margin expansion, I mean it's a almost 450 basis points margin expansion which they have delivered in 4 quarters, where the other large cap IT have either maintained steady state or have had pressure on margins. That's a positive surprise that Tech Mahindra has delivered. Going forward, I think even if I were to go by that same guidance of 8-10% growth for Tech Mahindra, perhaps another 1% or 1.5% coming out of further more margin expansion. Let's also see that Tech Mahindra margins are significantly lower even today than the other 4 tech companies. I mean, we're saying Infosys, Wipro, TCS and HCL Tech. So Tech Mahindra still has significant catch up to do. Also, that over the last 5 years or maybe last several years, this has been a shift from a specialized domain specific to a generalized IT company. Generalized IT, a lot of other sectors, whether it's BFSI, manufacturing, the margins are significantly higher than telecom, which is what historically it has been. So margin uptick could still play out over the next 2 years at about 12-13 times 1 year forward, based on the guidance of the management itself. I'm not really applying too much of my mind in terms of whether they'll do better or less. Even if we would assume that base case scenario, I think valuations are reasonable if they consistently deliver. I mean, there is upside to the stock. So it's a buy on declines according to me.
Okay, buy on declines. So it's a bullish call that's coming in from Vivek. What about you? What's your view on Tech Mahindra? What did you make of the numbers?
So I think the numbers were a mixed bag. However, few things that I'd like to highlight is that the global environment for IT is turned positive, and with money flowing back into the US from the tax cuts, will lead to pump priming of the US economy. They're the largest customers. They have good exposure to telecom, and 5G rollout will see them getting 2-3 good deals globally. They have investments in LCC and Comviva. They've turned them around very well. Okay, enterprise software is growing. So all these businesses, I think, will add to the margin flow. They've done acquisitions in digital space also.
Okay.
So I think the drag which was there on these subsidiaries is now being reduced.
Okay.
So I think at this price, at 14 times FY20, I think the stock is very cheap, and there is low risk and potential for up movement.
Okay, so it's a view that's coming in. It's not a bearish view at all. Dharmesh is saying that it's fairly valued at this point of time. He's talking about Tech Mahindra. Vivek is extremely bullish on the management guidance and the commentary. And Vinit also echoes the view in terms of valuations being cheap. There could be more potential upside on Tech Mahindra. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next leg of the show, we talk about the steel sector, and 2 companies are trying to vie for the #1 position in India. Tata Steel always was the #1 before they lost out position to JSW Steel for the past many years. Now with the big capex lined up, Tata Steel seems to be hunting back in the game in terms of being the #1 steel company in India. But which is a better pick, Tata Steel or JSW Steel? We'll ask our guest. Vivek, I'll start with you. Which one do you prefer?
Well, JSW, of course, has turned out to be much better than Tata Steel. And let me give you a certain context. While Tata Steel has more than 50% raw material linkage in terms of captive mines for iron ore and coking coal, JSW has actually got no mines. It's only a very efficient and a strong converter in that sense. So in terms of conversion margins, if you were to exclude the material cost, in terms of purely conversion margins, JSW is like by far better than Tata Steel as far as domestic operations are concerned. That's #1. #2, the capital cost of the capex cost per ton for what JSW has already done, and even the 5 million additional expansion that JSW is in the process of doing, is coming at a significantly lower capital cost compared to Tata Steel's Kalinganagar expansion, which is also, I think, about equivalent of about 5 million. But both 5 million equivalent capacities, JSW is at least about 30% cheaper on the, on the capital cost. So as a result, JSW earns significantly higher return on capital and return on equity. Debt levels are lower on a like-to-like basis for equivalent capacity between JSW and Tata Steel. So balance sheet and capital discipline, JSW has got much better. I'm not saying Tata Steel is, I mean, in terms of capital discipline, but is sometimes it's just a matter of the kind of capacity and location which perhaps makes a difference. So it's not, that's one thing. Another aspect which is playing out in the global metals and steel space. When the raw material prices, iron ore and coal prices are at elevated levels, Tata Steel will tend to do better because their material cost is lower because of captive mining, and that's where JSW has a disadvantage. But what we have now and likely to play out over the next several years, China has shut down or is in the process of shutting down a lot of steel and metal capacities. As a result, your end product prices at elevated levels, number one. But as a result, all your mining output, iron ore, coking coal and all, those prices have remained soft because they now suddenly you see that all of those consumers which are steel companies in China, a lot of those customers are no more there, and hence the difference between material cost or your base material and finished prices, the margins are higher. So the advantage which Tata Steel has because of captive mining, a lot of that advantage is blunted because of soft material price scenario, while on the selling price both have the advantage.
Okay.
So going forward, JSW will still see further margin expansion, while Tata Steel will not.
Okay, so is JSW the pick that Vivek has selected? Vinit, JSW Steel or Tata Steel, which is the better pick?
Yeah, I echo his sentiments. I think I'm very uncomfortable with Tata Steel's debt profile, and JSW pure play on the Indian market. So he obviously becomes the largest domestic player, and on all the parameters pointed out, ROC is very good, 22%. Their EBITDA per ton is around 5,000-6,000, can reach Tata Steel's levels. So there is substantial scope for the price escalating from here.
Okay, so JSW is your preferred pick.
JSW is the preferred.
Okay, so
pick
two for JSW, will it be a third JSW or you prefer Tata Steel?
I would prefer Tata Steel.
Okay, what are your reasons?
The reasons being, see, why we are buying a steel company. One reason is the demand has been good, prices have been on uptick, and the primary reason for that is, lack of production from or the cutting in production in China. So this is what is doing the balancing act for other steel manufacturers across the world. In that basket, if you compare like to like standalone business of Tata Steel with that of JSW, more or less both on the same parameters. There's hardly any difference.
Okay.
Some operating efficiencies there in say JSW Steel that is being matched by the captive mining of Tata Steel. So same amount of revenue, same profitability, same EPS on a standalone basis. Debt levels Tata Steel has lowered debt on a standalone business than JSW Steel. What happens is their overseas acquisition of Chorus, which has turned the entire thing out of favor of Tata Steel. With global economy picking up, China cutting down on production, and now their overseas operations have turned into black. So as of now, around 30-35 rupees is the standalone EPS of Tata Steel, which is getting eaten down by their losses from the overseas counterpart. Assuming, say, 85,000 crores of debt is there on the Tata Steel consolidated balance sheet, even 30,000 crores goes away. They have been selling off all the assets. They have been, trying to get more fitter out there. So that will add to 20 rupees kind of EPS just on the present business scenario. If they match 5-6% kind of a margin, which steel businesses normally do across the globe, this EPS will double to 70 rupees.
Okay.
So JSW as of now is available at 20 times PE multiple. Tata Steel also 20-21 times. This year they will be hitting around 25 rupees kind of an EPS, assuming that 2 quarters go well. Third quarter number is still to be there. But this has a potential to deliver an EPS of 70-80 rupees.
Okay.
So at 1,20,000 kind of crores kind of a top line revenue, so you can have a doubler out here.
Okay.
And the theme is we are just buying steel companies because lack of production from China and global demand picking up.
Okay.
So I would prefer Tata Steel.
Okay, so 2 for JSW Steel, and Dharmesh is indicating that Tata Steel would be his preferred pick in this basket. And finally, a lot of correction has happened in the mid caps. It started, but whether it will go on or there could be a rebound is for anyone to guess. But we're asking our guest which is a good mid cap that someone should buy for at least a long-term hold. So we'll ask our guest first. Dharmesh, I'll start with you. What's your view on mid caps? Any preferred pick?
See, mid caps as of now, this month has seen a good amount of correction happening, and I think this traction of correction is likely to continue going forward. But at the same time, there are a couple of mid cap names which should merit attention when the stock prices are correcting and there is a valuation comfort being played out there. So I would still stick my neck out with the infra space. And in the infrastructure, I think government has already promised a lot to be done. And in budget, the outlines will be there, how that money is going to be spent, and the priorities, the sequence of that spending which will take place. So rather than going to the pure infra play, I mean EPC kind of a play, it would rather be a project management kind of a play. So NBCC stands out there. Okay. 80-85% of the revenues through project management consultancy kind of a business. It's asset-light model. Balance sheet is very strong. Top line somehow has been stagnant over last few years, but 70,000 odd crores of order book they are having. 6,500 crores, top line they have been booking, steady state kind of a margin, which is likely to pick up going forward. So it's just scalable because you just hire, laborers and contractors and project management consultants, and you implement the project. So that is the type of business they are into. So I think with 230, 235, the stock price is trading as of today. So that gives us sufficient comfort on 50 to 40 kind of a P multiple. It has already come down. So one should be buying into declines of NBCC. Other two stocks which one would like, PTC India Financial Services, Renewable Energy Finance segment. It's a good buy, and BLS International. I have talked about this stock multiple times.
So NBCC would be your top pick at this point of time. Okay, Vinit, NCL Industries. I believe you all came out with a report also on this one. Why and what's the target that you all have put in that report?
So we have a target of doubling.
Okay.
And
1 year, 2 year target.
FY20 target.
Okay.
And we expect revenues to double and profits to treble.
Okay.
And valuations are quite cheap. It's around $65 per ton. They are both into the building product space. They're into cement. And both these businesses are very well positioned in the fast growing market of Telangana AP. So we believe that three companies which are operating in the Hyderabad belt, so they are Sagar, Deccan and NCL, will outstrip capacity utilizations of all the other players in that zone. So we like these companies. They have got good.
What's the target that you have given on NCL? Do you have that handy on you?
So I think it's a doubler. So from 270, 510 was the target.
Okay, so it's a doubler. So NCL is the company that Vinit is saying as a mid-cap pick. And finally, MGL. Why do you like MGL, Vivek?
Well, to put things in context, all of us believe that markets are ripe for a correction, and we could face some rough weather over the next couple of months. So in that context, it makes sense to be with companies which are low beta, number one, whose businesses are not cyclical, secular, long-term compounding growth stories at valuations which are not terribly expensive. And Mahanagar Gas fits from that perspective. Basically a gas transportation and a distribution company operating in Mumbai, Thane and Raigad districts, a huge growth potential because in terms of penetration or in terms of conversion to gas, which is yet to happen compared to liquid fuels. In terms of the pricing, the pricing of gas is at a discount to the competing liquid fuels. If we are talking of LPG in case of domestic and commercial, in industrial we are talking of either diesel or any other fuel which is used for where gas could be a substitute. And of course in the auto it replaces or substitutes for petrol and diesel. Pricing is discount to most of the other liquid fuels on a like-to-like basis, but in spite of that, they are pretty much assured of almost 30% EBITDA margins, even at that kind of pricing, almost 50% gross margins that they work with. A zero debt company, close to 700 crores of surplus cash on the balance sheet, does about 30% return on capital or return on equity adjusted for the cash on the balance sheet. And a very robust business. Valuation at about less than 15 times EV by EBITDA, about 18-19 times on a earnings basis on 1 year forward. Very reasonable. A terrific, I would say 15 to 18% long-term growth story in terms of earnings, which can happen for the next 8 to 10 years without much effort.
Okay, so MGL is a stock pick that Vivek is spoken about. Before we move, here's a quick recap of the guest views on the top steel makers that they like and the top mid-cap picks that they like. Okay, Vinit, Dharmesh and Vivek, thank you so much for joining me on the show. But before we end the show, Amber Enterprises listed today. It made a stellar debut on the bourses. The air conditioner manufacturer listed at a premium of more than 300 rupees on its issue. And Bloomberg Quint's Ridhima Saxena caught up with Jasbir Singh, chairman and CEO of the company. And he says that the focus remains on improving the working capital cycle and will improve on the company's cash position. Let's listen in.
So net working capital cycle days, today stands at 29 days, and we've, there's a large part of operating leverage which has come in because creditor days have increased, debtor days have a bit reduced. Absolute terms inventory same, and it has come down from 64 to 29, and we are expecting some better growth in that number this year. I think we are targeting positive towards 29, on the lower number.
Going forward, considering that the return on equity has suffered because of the long working capital cycle, once you improve it to 29 days, by how much do you see the return on equity in the next fiscal once?
See, as I told you, there's a lot of operating leverage coming in. We've already reduced from 64 to 29. And, ours is a modular capex cycle, where entry barriers in our sector is quite high. So we think that, we are going for a betterment on this number. And largely, the return on equities will be, if you see my H1 results, it demonstrates that we are already progressing well. So in H1, we've delivered 27% top line growth. And PAT, we've already achieved what we achieved in the complete final year last year. So ROEs have, on a run rate basis, they've already touched 16%. From last year 9%, and we are definitely looking into a better operating leverage which will cover northwards towards this number.
So one last question on client concentration. So most of you talked about customer expansion in the first answer itself. So most of your clients, it's the top 10 clients that you get most of your orders from. So how do you plan to diversify that and increase the clientele, especially take a little more from the top 10 and give it a little more to the top 20 or something like that to reduce the risk of client concentration?
So we've worked on client concentration in last 7 years. We used to bank on one customer to a tune of 76%, and that customer today contributes only 9%. So none of our customer today is more than 22% banking on single customer. So we keep on, that is very much in focus. And, the endeavor is, one, to increase the wallet share in every customer by cross-selling different products and giving more comprehensive solution to customers. And second is that bringing in new customer at all. So that also, whole put together, if you see, it converts into a nice client concentration. So we are not banking on even one single customer. So we are serving 8 out of 10, top 10 brands today. And we continue to bring in more customers. Exports are also looking positive now to increase. We are getting good inquiries from nearby region. So that also will definitely complement the client concentration part.
Okay, TVS Motors numbers are out. If you're looking at the revenues, 3685 crores, it's come in much higher than the estimate. Profit seems to be lower, 154 crores versus our estimate of 168 crores. Revenues at 3685 versus our estimate of 3580 crores. The counter seems to be going down. EBITDA is coming in line with estimate. So pretty much an inline set of numbers. It seems that it's an inline set of numbers. Profits, probably there could be a one-off or higher taxes, but at least operationally, if you're looking at TVS Motors, it's a number that's coming in line with what we had anticipated. So Yatin will be miking up soon. Yatin, are you here? Okay, so Yatin is not yet here, but the face of it, it looks like it's an inline set of numbers. Reacted negatively first. See, the EBITDA margins at 7.8% versus Bloomberg estimates of 7.9%. So it's absolutely an inline set of numbers that TVS Motors has reported. The top line growth is better than what the street and we were anticipating. I don't have the exact breakup in terms of why the net profit has come in lower. than what was anticipated, but on the top line and on the EBITDA front, it's totally in line with what we were anticipating. Yatin is mic'd up. Yatin, what did you make of the numbers?
Darshan, as you are rightly pointing out, the profit growth is lower than the street expectations, but on the revenue and on the EBITDA front, the earnings seem to be in line with the street expectations. In fact, we were expecting margins to be close to 7.8, and the actual numbers are also 7.8 in terms of the overall operating performance. But if you look at the profit growth, it is largely lower due to higher taxes as well as lower other income. This time the other income is quite low on a year-on-year basis as well as on a sequential basis. The plunge in the other income component is quite high, and that is the reason why the overall profit growth is much lower than what it usually is. But if you look at the revenues, they saw a growth of nearly 14%. So, in line with estimates there as well. If you look at the net revenue growth, there was a 23% growth. On overall basis, if you look at the EBITDA growth on absolute basis, it is almost 31%, largely in line with the street expectations. Again, here the absolute EBITDA figure is 286 crores, more or less in line with the street expectations, and profits are coming in lower than street expectations, but that is on the back of higher tax outgo as well as lower other income. But net, if you look at TVS Motors, earnings are in line with the street expectations.
Okay, many thanks for that, Yatin. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.